Alright, what's up family? So I was going to upload a video about 8 stocks in which you could invest in right now at Jamaica. However, I figured some of you might not know the lingua or what it means. So in this 3-part video series, I will explain what is the PE ratio, what is price to book ratio, and what is return on equity. And then I'll upload the video Monday. Alright, so price to book earnings ratio is simply what the price of a stock relative to its earnings is. So let's say we have a Chinese restaurant and it has 100 shares outstanding and each share is valued at $2. This means that the company would be valued at $200. This company also makes a total revenue of $50 per year. So say you are a businessman and you will want to buy the entire business. Typically, the owner of the Chinese restaurant will not sell you the company for $200. Matter of fact, they will try milk as much money as they can out of you. So they won't sell you their company at that price because in 4 short years they would be able to make back their money. Instead, they say that they would sell you the company for $1,000. This is 20 times earnings. So if you buy the company, it would take you 20 years in order to break even on your investment, assuming revenue stays at the same rate. And that is how you would calculate PE ratio. The price, typically the value of the company, which would be the outstanding shares multiplied by the share price divided by the company's earnings. As investors, we want to invest in companies with a lower PE ratio, as this means that it will take a shorter time for us to break even on our investment. Also, don't think that because a stock price is expensive means it is overvalued as it relates to its PE ratio. For example, as an investor, you are placed with 2 Chinese restaurants to buy and you are deciding which one to choose. The first restaurant has a price of $1,000 and is earning $50 per year, and the stock price is currently $2 per share. And the second company is priced at $10,000 but is earning $1,000 each year with a stock price of $50. Company A PE ratio is 20 because it's $1,000 divided by $50, which would equal 20, while company B PE ratio is 10 because $10,000 divided by $1,000 would equal 10. So even though company B stock costs $50 per share, it is better because for your money as an investor, you would make it back within 10 years rather than 20. Now, there is forward PE ratio, which basically predicts what a company's earnings might be like. Hence, investors will be able to know if buying the company stock right now is a bargain compared to waiting later down in the year. But that's for another video because it requires a bit more calculation. So, see you in the next video. Remember to pump the stock. Love you guys. Peace.